Welcome everybody to today's webinar on demystifying M&A, what every business owner should know. My name is Stephen Burgess and I'm part of the enterprise team here at LegalVision, and I'm pleased to be partnered with Morgan, who will be running this webinar for you guys and going through everything about M&A. Now, before we begin, a couple of housekeeping items. So you'll receive both the recording and the slides of this webinar in your email off the back of it. Any questions that you have pop up throughout the webinar, please submit them in the Q&A box and we will answer them when we get to the end. And you'll also receive a feedback survey off the back of the webinar. If you could fill that out, provide any feedback or any advice on the webinars, we would really appreciate that. Now, by viewing this webinar, you are eligible to receive a complimentary consultation with myself to discuss how LegalVision can potentially help your business. And if you are interested in having this legal health check done, leave your contact details in the survey that appears off the back of the webinar, or you can contact us via our website. Now, today we'll be discussing everything on the screen. Morgan, I might throw it over to you to talk through the agenda and we'll kick on from there.
Thanks so much, Stephen, and great to have you all here. I can see some familiar names, so I'm really glad that you've joined us. So today we're talking all things M&A that business owners need to know, and what we'll do is go through really what is M&A and what does the M&A landscape mean, in addition to some common misconceptions about what it is. And then I'll also be going through some of the key things to be aware of in terms of going through the M&A process, starting from DD through to what gets included in the contractual documentation, and then at the end, what actually happens after you close a deal. So this is effectively post-completion integration of businesses. So if we move to the next slide, Stephen. This is the introduction around what actually is M&A. So at its very core level, this is about the buying and selling of businesses and assets and/or companies. And I'll get later in this presentation to the distinction between a share sale and an asset sale, which informs part of that. But M&A can also extend to other things that you may not necessarily think it does. And that can even extend to intragroup restructures, reorganizations, and investments more broadly. All of that can fall into the bucket of what mergers and acquisitions does entail. And again, it's not just about the big conglomerate sort of buying up multiple companies. M&A is something that is used not just to exit a business, but effectively also for scaling up a business, growing a business, and succession planning of when people or founders need to exit a business and ensure that it then moves into the right hands. And it is interesting, there are some common myths which I'm sure come from the likes of programs like Suits and, American Psycho, that M&A is really something that's only confined to the billion-dollar companies of the world, to the Rio Tintos. And that's fundamentally not the case. Here at LV and, historically in my experience, we do everything from very small acquisitions and mergers all the way through to $1 billion plus. And obviously the structure of those deals changes quite significantly based on the valuation. Another misconception is that it is all about the valuation, and that's also it's a really key part of doing an M&A deal. Of course, everyone wants to be comfortable with the price that they're either selling a company for or buying a company for, but it's also about strategic integration, the fit. Are you comfortable with who's buying the business? If you are doing a partial exit, which means that only a little bit of the company or business is being sold, you need to ensure that there's also some commercial alignment to that level. And finally, advisors handle everything. I always like to say lawyers do, for the most part, handle everything, at least 95%, and can assist. But there is a really core piece around management and CEOs and their involvement in the process to ensure that they're comfortable with the way that the deal is progressing. So in reality, M&A deals collapse for a multitude of reasons, but more often than not, it's when the parties are not prepared to enter into an acquisition. So that may be by virtue of incorrect DD being done or inadequate DD being done, or just general readiness of the business. It may realize that once it gets into the DD process, it doesn't in fact have the contracts in place that the buyer or investor wants to see. So that's really one of the common ways that we see it collapse. Stephen, if you wouldn't mind moving to the next slide. So the M&A landscape right now is really, really interesting, and it does change over time. So for instance, during COVID, it was a very different space in M&A, and what we saw most of is effectively distressed acquisitions where companies were struggling financially, and they ended up getting bought or sold in what we refer to as fire sales, which means it had to be done really, really quickly in order to preserve liquidity and make sure that that particular company didn't need to officially declare a liquidation or a bankruptcy. But what we're looking at currently as of 2025 is a really, really high amount of M&A, and in particular consolidation across healthcare, SAS, professional services, all those types of technical spaces as well, and a real interest and involvement, particularly in cybersecurity and the AI space too. Within that, we have different types of buyers. So some may be strategic buyers. And when I say a strategic buyer, this is someone who is experienced in M&A and often a bigger company, and they look to buy or sell companies as a means of gaining efficiency of scale. So it can be a growth mechanism, and they may want to bolt on a number of other companies in the industry in order to make sure they have the biggest company and the most efficiency of scale. Now, there is also PE or private equity buyers, and PE funds are funds that effectively invest other people's money in certain businesses and then exit within a short period of time, so typically under 5 years. And they come in and try and rejig the company and ensure that revenue is upped as much as possible. And in the end, they inevitably get the return on that investment. Another one is a management buyout, and this is where an employee or management buys out the company from the shareholders. It often happens in circumstances where succession planning is a consideration. But outside of this, there's often just individual to individual, company to company. You might identify, oh, I really like the look of that business. I'm interested. You make an offer and it just ends up going through. So there's all kinds of strategic buyers and individuals and companies that participate in the M&A space. As I mentioned just before, there's 1,000,001 ways to structure a transaction. And a common misconception really is that it either needs to be an acquisition of assets, which means that you buy all of the assets and strip them out of a company, and effectively you pick and choose which liabilities you want to take, if any at all, versus a share sale, which is when you buy 100% or a specific percentage of a company. And by virtue of that, you then become the shareholder and inherit all of the assets and liabilities attaching to that historical shareholding. Now, those are two sort of umbrella ways to do this. It really is how long is a piece of string. Sometimes we do a hybrid asset sale, a hybrid share sale, a share sale of only 20% of the company. We do, full exits and then a recapitalization, which means you sell 100% and then the incoming buyer takes on debt to refinance and recapitalize the company. So there are all kinds of weird and wacky ways to do M&A. And in all circumstances, it's really important that you are comfortable with the way that it's being structured and you're maximizing the value from the structure that's been chosen. So in terms of sort of some of the current trends that we're seeing in M&A, we have in recent years seen a fairly significant uptick in what's called an earnout or deferred consideration. Now, this means that when you buy a business, you don't pay 100% of the purchase price on settlement of that particular transaction, but instead you may pay it sort of 6 months or 12 months later, depending on how the business goes. And why people and buyers specifically press for that more often than not is to minimize the risk that you buy 100% of a company, it ends up not doing as well as you thought it would. All of a sudden you're out $2 million straight away. Whereas if you use this sort of deferred consideration or earnout mechanism, instead it may be that you pay the $1 million upfront, and then the balance of the $1 million is secured for that 12 months, just so you get surety that the business and the company does what it's intended to do, and then it's paid at the end of that. There's a few other things around the regulatory space. The Foreign Investment Review Board is, again, a very hot topic right now, and the Australian government is really looking to provide protection for Australian shareholders and businesses around foreign investment. So there are a number of rules and hurdles to get through if a foreign investor or foreign buyer is looking to acquire an Australian business. And similarly, the Australian Competition and Consumer Commission has put in an array of prohibitions on acquisitions and mergers that may be deemed to be anti-competitive. So a good example is it's not useful for Australia if Woolworths buys up every single supermarket chain. And that's something the ACCC effectively looks at to make sure that there's no anti-competitive effects from M&A activity in Australia. So if we move to the next slide, getting deal ready. So we've talked about the trends and sort of the landscape that we're operating in now, but getting deal ready is probably one of the most important parts. And look, in my experience, is something that gets overlooked more often than not. And getting deal ready is really thinking about, even if you're not currently in the process of negotiating a deal, you haven't had an offer, there's nothing sort of hard or firm on the table, companies should always be thinking about an eventual M&A deal or exit. And what I mean is you should always keep contracts and housekeeping such that if a buyer or investor was to come and lift the hood on the business, they wouldn't start asking a million questions around why wasn't this done, why wasn't that done. So you should always think about being deal ready, even in circumstances where that's not something that's on the radar. And as we've got here on the slide, there's three really core areas in terms of deal readiness. The first one is financial, and this largely relates to financial statements. So as part of a due diligence process, you will always be required to submit the financial statements of the business. There's really no way around that. It's used to effectively justify the valuation that's been put on the company. And it's really making sure that you've kept financial statements up to date, they're appropriately done. If there's, numbers that look slightly out of whack because the accounting wasn't done correctly, that is again something a buyer or investor would look at very, very closely. Now, the next one is the legal piece. I've had more acquisitions than I can say where I'm acting for the seller or the company that's selling the shares, and they go into the deal and realize that they don't even have the documents like a constitution or a members register, and those documents are in fact required for compliance with the Corporations Act. So more often than not, we need to reconstitute or rebuild a lot of that documentation as a requirement of the particular acquisition or merger. And that's a very normal part of the process. But again, if those activities are done sooner rather than later, you don't have to be as reactive when it comes to having to do it as part of a DD process. Now, the final one is operational. So a buyer or investor will always look at who are the key persons, is the IP adequately protected, and or what is my risk that when I buy the assets or the shares in this company, the key people just walk away. And look, it does happen. And as part of the operational deal readiness and DD piece, they will be looking at the people in the business, the trademarks, the patents, what have you got in place in terms of registration of intellectual property? And without that, it really does affect the value proposition of businesses and companies. And I've seen 1 million share purchase agreements where it's required for IP to be registered before anyone will proceed with the actual sale. Now, again, to the critical questions, do you have a clean structure? So as I said, do you have the documents under the Corporations Act that you should have? And outside of this webinar, I'm very happy to answer any questions about exactly what that list of documents looks like. Do you have any significant debt? Because if you have significant debt on your financial statements, a buyer or investor may require that to be paid out or dealt with as part of the M&A deal. And then finally, do you have contracts like around IP, like around clients that will stay in place once someone comes in or can effectively be assigned to them? Because if they can't, if you have handshake agreements only in place or sort of gentlemen's agreements, that really doesn't help an investor or a buyer. And again, that can significantly affect the valuation of a business or a company. So here, I know it's a scary figure, but there's often 3 to 6 months work of pre-sale. But as I said here, often that can achieve a 1 to 2 times multiple uplift in the purchase price that's been offered. So if we're looking at a $1 million purchase price, if this pre-sale work has been done, often we're looking at 2 to 3 million in terms of an uptick, which is obviously a really, really significant increase. So next slide. So valuation and deal structuring, and this sort of dovetails neatly from what I was just talking about. A question that I get quite often is, how do we figure out what the purchase price is? How does that work? Who figures it out? Is it a joint activity? Is it on us to do it? And the answer is there's not necessarily a right answer or a right way to develop the valuation and the purchase price. But what is the most common is a company is looking to enter into a share sale of 100% of its shares, will often go away and get a valuation of the company. And that can typically be done by an accountant, a commercial advisor, or someone in that space can assist with that work. Then the valuation gets presented, and let's just say, using numbers, it's $10 million. The valuation then informs the purchase price. So we use the valuation of $10 million and we apply what's called an EBITDA multiple to that number. And the EBITDA is the earnings before depreciation, interest, tax, and amortization. And if the EBITDA in a business valued at 10 million is, let's say, 5 million, we say often the purchase price is 3 times the EBITDA. So then the purchase price becomes 15 million. Now, that's certainly not an exact science, and it really is also industry dependent. So businesses and companies that operate in the technology space, there's often a higher multiple applied to that business just because we're in a world in which there's a really strong value proposition attaching to new forms of technology. But that is generally how the valuation to purchase price bridging process works. Of course, I should say that doesn't mean that you can get a third-party buyer that says, look, I don't even need to see the valuation. I'm offering you $20 million. I'm really motivated. That can happen, albeit less often. That's a little bit of a unicorn scenario. And then also we've got the purchase price now based on the bridge between the valuation, and then you determine really what the deal structure will be. So again, as I was saying before, we're seeing a circumstance in which earnouts and deferred consideration are more common than not. I would say 65 to 75% of the M&A deals I do involve deferred consideration or holdback earnout consideration, as we've discussed. And again, that really depends on the appetite of both parties. So if I'm acting for a buyer, I will typically press for holdback or earnout consideration because it protects the risk that the buyer buys something and it just doesn't work. Whereas on the alternative, if I'm acting for the seller, we would typically resist that type of earnout or deferred consideration on the basis that it's obviously preferable for a seller to get all cash or consideration on settlement rather than have the risk that it's tied to business performance or KPIs that may or may not be met. But all that to say, again, as I was mentioning earlier, there's no right way to structure a deal. We look very specifically at the valuation, the purchase price, and what the business does in order to formulate the best deal structure. And deal structuring is really one of the key components that we do here as part of the M&A practice. A concept that comes up a lot is what's called a debt-free, cash-free working capital transaction. And I confess, when I was a junior, I really struggled to get my head around what this means. But in effect, what it means is on settlement of a deal, a buyer expects there to be a normal level of cash and general working capital in the business. They don't want to use an analogy, buy a car and realize there's no petrol in the tank. That's not ideal. So normally, prior to settlement of a deal, a purchaser and the company will agree on what is a normal level of working capital. Let's just say it's $1 million. That will be what should be in place as a settlement of the transaction. So the amount of petrol in the tank. If it so happens that the number is higher or lower than 1 million because of general fluctuations in the business, again, if the petrol's higher, then inevitably it makes sense that a buyer should have to pay more because they're getting more petrol in the car. So if the normalized working capital is higher than $1 million, there is typically an adjustment in favor of the seller or the company, versus the flip side, whether if it's lower, there's typically an adjustment that goes the other way and the seller has to pay back some of those funds to the buyer. Now, it also means that there's an assumption that all debt and cash will be cleared in the business and it will just be that level of normal working capital without the surplus. So that's the sort of petrol analogy, is the best way to think of it on a very sort of fundamental level, but it is a construct that comes up in most of the transactions that we do. But again, I should note that in terms of the structures, tax advice is key. What we don't want to see as transactional lawyers is we've structured a deal in a particular way, and then we realize that it's actually not tax efficient or effective for the party that we're working for. So core tip, engage tax advisors early. We have multiple people that we work with, referral partners as well, and we can always put you in touch with someone if that is required. So next slide, please, Stephen. So again, we've done the DD process at this stage. We've got our purchase price and our deal structure. What happens next? And a lot of questions that I get are actually, well, hang on, what is the point of DD? It's not just a fact-finding exercise about a business, but what it also does is inform the contract in respect of that. So if I am doing a DD process and I lift up the hood and find that the company has overstated its financial statements by $4 million, then that is something that as a lawyer, I'm going to need to manage and deal with as part of the contractual documentation to effect that sale. And it may be that I then say in the contract you're required to redo the financial statements and reissue them. Or on the flip side, it may be that, well, I'm going to now decrease the purchase price by the amount by which the financial statement was inflated. Now, that's just one example. There's a host of things and risks that come out of DD because no company is perfect in terms of housekeeping, especially when we're working with startups and founders. But it is important to note that things that are material that come out of that process will indeed be the risk management tools that we take forward into the contract. Now, again, at the risk management tools, we've got three of the major ones here. Warranties and indemnities, as I've just alluded to in terms of the financial statement piece, are things that we require from the company around promises or specific representations that we need. So again, using the example of the financial statement that's been inflated, in a contract, we may well say, because of that issue that we found in DD, I'm actually looking now for a warranty or a promise from you, company, that there's no other issues that you know about or that's in your knowledge, or no other circumstances in which you've inflated the financials. And that may be a promise that I then ask for from the company, given the results of DD. Similarly, there can be warranties about all kinds of things. Typically, you're always required to warrant ownership and the correct shareholding of the business or ownership of the assets, because without ownership, a deal to purchase it doesn't really make sense. Now, I won't get into too much detail, but there is something that's called warranty insurance. And if you're a seller that's required to give a whole host of warranties, not just in circumstances where the DD has uncovered risk, but it may be that it's just the appetite of the buyer and their requirement. There is a thing that's called W&I insurance, and that's actually huge in the Australian market. And you can actually get insurance to cover a breach of your own warranties. So an insurer will say, no worries, if you pay us X, we will be on the hook in case the buyer or investor finds out about a breach of warranty. You will have no liability. And it's something that's certainly more common in higher value deals. So above 50 million is typically when you start to see W&I insurance used. But all that to say, there are a host of risk management tools on both sides that need to be thought out very carefully and catered for very carefully, coming out of both DD and how the purchase price and valuation has been structured. So next slide, please, Stephen. So integration and completion, these are two parts of the M&A process that really do get overlooked. Sometimes people really focus on negotiation of the purchase price of the deal, of the contractual arrangements. All the while, there is a piece where after this deal happens, there's going to have to be some kind of actual physical handover and transition. And that's a part that, as lawyers, we're not always strictly involved in the operational integration phase. Yes, we can provide advice, but it is a really, really important phase. So talking first to completion, this is effectively a different word for settlement. And what it means is all the requirements of the contract have been met. So you've agreed you won't inflate the financial statements and there's no other ones that you're aware of. You've agreed to redo the documents that were identified in DD as having been not up to scratch. And then both parties are ready to actually pay the money and get the money. And that's what we refer to as completion of a deal. It's the point in time when money actually changes hands between the respective parties to that transaction. Again, in higher value deals, you might see 30 requirements before completion can be done. In smaller deals, they tend to be ring-fenced to 4 or 5 really key ones. And that's typically completion of due diligence, assignment of documents and to the requisite people, and also notifying any counterparties that you have to contract that there will be an acquisition, so a change of control. So they tend to be fairly ring-fenced, and often the number is commensurate with the value of that particular transaction. So after you get the money, it's always very exciting. We always like to confirm completion has occurred. It's a really big step, obviously, if you're doing a merger or an acquisition. But then often, particularly if there's a 100% share sale and you're exiting completely sort of hands off and someone's coming in, then you begin the phase of what actually happens now? How do I physically get this business across? And often a purchaser or buyer will need to come in, collect all the records. They may want to move into the office space. They'll take over the leasehold interest, and that integration or operational integration phase can often take 6 months to 12 months to get correct and to do it. Now, again, that's complicated often in circumstances where you're not just doing 100% sale, but a partial sale, and instead it's a merger of 2 companies that are coming in 50-50. Because then in respect of operational integration, we're talking about the pooling and the collection of a significant amount of assets that needs to be done physically. So the point of that is, please, doing an M&A deal, be prepared for the operational integration piece of it, bank accounts, it's all the little things. We, of course, as lawyers help with that and formulate lists, but it's really important that you've chosen a party to a transaction that you're happy to do the integration process with. Now, the warning at the end is one of my favorite warnings. I don't like to scare clients, but poor integrational phases post-completion is the #1 reason why value of a company is lost. If there is a poor handover or poor integration, there can often be a very direct effect on the valuation and trading prospects of the business that's just been acquired. So it's just something to be aware of. Now, next slide, please. So we're at the end of the key takeaways. So we've gone through the landscape, what M&A is, and really some of the key touch points as part of the process. But in terms of the key takeaways, there are some really cool things. So again, it's remembering that M&A is not just about exits and suits and the big conglomerates. It's also a growth strategy and something that any business really should be thinking about as part of getting efficiencies of scale, growth, all those kinds of things. It's a really important part of that. Now, preparation, so doing the DD cleanup and clarity, create significantly more value than perhaps any other part of the process, even more so than negotiating the purchase price. If you have a very clean record of documentation, a clean capital structure, it will significantly assist in the process and can often actually expedite a deal. So it's very important. Now, action items for everyone that's considering entering into a deal of whatever size, structure, whatever it may be. Know your numbers. So be aware that you'll need to get a valuation of the business and have the ability to back that up. So if, say, my valuation's 10, you can't present any evidence as to how you've reached a valuation of $10 million, that simply is not something that will suffice for the purposes of entering into a deal. So be prepared, know your numbers, and involve a commercial advisor or an accountant if required. Protect your IP. Now, this doesn't just have to be IP, but this is really about protect whatever the core value proposition of your business is. If it's client relationships, we want to see the client contracts. If it's IP, we need to see the registrations and, the patents, the trademarks, whatever you've put in place to protect that. And if it's staff, let's make sure we have adequate employee agreements in place such that a buyer doesn't come in and then each employee has the right to terminate for convenience all of the employment agreements. Now, keep contracts assignable. This means that, again, using the client contract example, make sure there are ways in those contracts they can be assigned, they can be novated to someone. These are very common provisions that always come up in contracts, but it's really important to keep them assignable. Now, the fourth one, and I don't just say this because I'm a lawyer that's worked in M&A for a long time, but do engage advisors early. If you get the right deal advice at the very beginning, including in respect of structuring, it's not just something that has the ability to expedite the process, but it's also something that has the ability to maximize the value of the deal and the purchase price you're actually getting. So even if that's not engaging a lawyer to do legal work, it's engaging a lawyer to have a call about how you might even go about it, or just an email around and thinking like this. We're also very good sounding boards. So I do encourage that early in the piece. Now, the final quote, one of my favorites: start acting like you'll sell tomorrow, even if you don't plan to for years. And this covers the array of things that we've talked about in this call, but it's about being prepared. I think companies that are prepared and set up documentations in their companies straight away inevitably have a much better run if they do go to an eventual exit, M&A transaction, or an IPO. And it's just about keeping that cleanliness and that clarity straight away. But that brings us to the end. I will hand over momentarily to Stephen. I can see a lot of questions, so I'm excited, but I'll let Stephen talk to the downloads first.
Thanks, Morgan, and fantastic points in the webinar today. That does conclude our main portion of the webinar. We'll move on to the Q&A shortly. However, you might find our publication useful on due diligence guide for purchasing a business. And if you do, you can download it from the resources tab or by scanning the QR code on the screen. We've also got another webinar coming up on the 30th of October at 11 a.m. Australian Eastern Daylight Time, looking at social media compliance and how to safeguard your brand and avoid common pitfalls with that. Now, as Morgan walks through the live questions and questions that were pre-submitted, I did just want to take a minute to talk about the LegalVision membership. Now, by becoming a LegalVision member, not only does your business get unlimited access to our full suite of 100+ lawyers for your business as usual legal needs, like unlimited document drafting, advice consultations, trademark registration, and more. But more so on what we spoke about today, it's getting that due diligence advice on corporate structure, and preparing and doing that background work ready for a merger and acquisition. If you are interested in having a look at the corporate structure, the due diligence, or even just having a sounding board to look at the LegalVision membership, what you can do is request a free consultation in the survey that appears at the end of this webinar, and we'll be in touch to help with that. It works with both small businesses who need someone like an in-house legal team, but there's also the option for anybody who is in-house counsel to have that further support and a further sounding board when it comes to that merger, that acquisition. Now, I'm going to hand back over to Morgan to start to answer your questions now. And while she does that, you'll see a poll question pop up. So it'd be great if you could answer that question, and I'll throw over to you again now, Morgan.
Thanks so much, Stephen. And I have 23 questions, which makes me really excited. Though unfortunately, I probably won't get through them all, but I will certainly endeavour for those that I don't get to respond to you separately after this webinar. But the first is from Ben, who's an online question, and it's a really, really good question. So on earnouts, how can the seller protect the earnout from being undermined by post-acquisition decisions, such as reduced budgets, diverted staff, or strategy changes? Now, this is a great question because this is a key consideration for sellers. If you are entering into a transaction that has an earnout, there needs to be those guardrails around what the buyer does in the business post-completion, because of course, Ben's correct. If a buyer comes in, gets rid of all the employees and all of the clients, there can be no real viable way for you to meet the earnout KPIs or the deferred consideration milestones. So what we normally do in this case is we include what's called earnout covenants. And these are restrictions that apply to the buyer or the purchaser of the business. And they mandate those things that they are not permitted to do during the earnout period. So 6 months, 12 months, whatever it may be. And the earnout covenants can obviously range depending on the structure of the acquisition. But I'm doing a transaction right now where there's about 12 of them, and the earnout covenants involve things like cannot make any changes to the business plan, cannot fire any employees, cannot make any changes to the financial software used in the business. And that's the way that we typically protect the seller's ability to meet the earnout or the deferred consideration KPIs as part of that process. Now, Bo is the next one, and he's asked another really good question around how is the normal working capital actually determined in the first place, and is that added onto the overall asking price? So in terms of how the normalized target working capital is calculated, this will typically be more of a conversation between the two parties to the deal. So normally you would look at the financial statements, let's just say for the last 5 or 6 years, and calculate on average how much debt and cash is typically in the business at a given time. So if we go back to a business, let's say we start with 2020 and we say, look, there was, $1 million of cash in the business in 2020, $2 million 2021, so on and so forth. We may then say, look, on average, it looks like the working capital in the business sits around 1.5 million. So there's no exact science again to how it's calculated. It can be more of a conversation and negotiation piece, but typically it will involve the review of the historical statements to determine the average cash and debt in the business. Now, it's not added on to the overall purchase price. It's simply a component of how the purchase price is calculated. So again, to use sort of the worked example, we've agreed in this case on the $1.5 million target working capital based on the average of just, the past business performance. Then we might say, okay, purchase price we've agreed separately is $10 million. So the 1.5 is not factored into that. The purchase price is separate, but we've then paid the $10 million on completion. And then in the month afterwards, we realized that the target working capital is actually 0. Now, what we'd say is that's not great. So the buyer, I bought in on the basis the target working capital is 1.5, it's now 0. And the result of that is the purchase price of $10 million would then be adjusted downward to cater for that difference. So the purchase price payable in the end, after you needing to give a refund to the purchaser, would actually be 8.5 million to cater for that decrease in the target working capital. So purchase price is always the same, but it will be adjusted upward or downward post settlement of the transaction on the basis of the numbers received at that point in time. Now, Terence as well has asked, should the professional that calculates the valuation be separate from the one performing the DD? So this is another really great question. And the answer is not necessarily, but it depends. So typically, let's say if your commercial advisor or accountant has developed the valuation, they've said it's $10 million, often it makes sense for that commercial advisor or accountant, because they already have knowledge about the company workings in the business, to be the one that does the commercial due diligence. Now, DD isn't just limited to sell side and buy side. If you're selling, you can also DD your own company and say, we've DD'd it ourselves, here are the results. But more commonly, it will be a different person, because you'll develop the valuation on our side, and then the purchaser will get a distinct sort of third party to come in and check that it's all okay. But again, it's one of those funny things. There's no black and white answer to this. Who does what in the process is typically just part of the deal structuring and negotiation. But the core part is making sure that you get a lawyer to do the legal piece, you get a commercial advisor or accountant to do the valuation, and whatever happens in between is a little bit, it can be open to conversation and discussion with the party to that particular transaction. So now we're going to the 20-odd pre-submitted questions, which makes me extremely happy. And so the first one, as a buyer, is it legal in Australia to use vendor finance to buy a business? Now, this is a really good question, because vendor finance is a really interesting construct. This is when the seller of a business loans money to the purchaser to fund the acquisition. Is it as common as other things that we see in M&A? No. Is it legal? Absolutely. But it needs to be documented properly. So if you do have a vendor financing arrangement in place as part of a transaction, as the vendor, you really want to make sure that you're entering into some kind of standalone loan arrangement to make sure that you're not out of pocket for whatever reason, and you will in fact get back the money from the purchase that you've loaned in order for them to buy the company. So absolutely legal, but really important to make sure that any loan or vendor financing arrangement is documented correctly as part of a sale. Now, key legal pitfalls in negotiation of an M&A deal, another really good question. So more often than not, I think in terms of legal pitfalls, failure to do adequate due diligence. Now, this isn't necessarily a legal issue. This is an issue that applies to all parties in a transaction. But what we don't like to see is if I'm acting again for a seller or a company, the purchaser comes in and says, oh, I'm comfortable with the results of DD. But then a month later, they say, oh, look, we actually didn't realize this, X, Y, Z when we were doing the DD. And now we need to adjust the purchase price, include this extra thing in the document. That's a really poor outcome for everyone involved, and it can obviously cause frustration. So the pitfall here is making sure that everyone's doing their DD, not just legal DD, but they know what they're entering into and getting into as part of the DD. On a more legal note, when I'm negotiating a transaction, and negotiations can get heated, which is part of the reason we love this job, a really big pitfall is not knowing what is market standard for a particular deal. So when we talk about market standard, it means what's normal for that business. So what's normal and market standard in the sale of a tech company is very distinct to what's market and normal standard in the sale of a retail company. With tech companies, it is market standard to have warranties around the ownership of the technology. In retail, that does not apply to the same standard. So one of the key things that comes out of poor negotiations on a deal, or when we get wins because the other side isn't clear, is when we say, there's no reason to push back on this point because this is in fact market standard for a transaction of this nature. And it's something that is really, really important to be aware of and abreast of as a lawyer, particularly when you're entering into certain deals, particularly where you're industry agnostic and you need to know across a multitude of industries, but it's a really core negotiation technique as well. So next question is, what are some key legal provisions in an agreement in an M&A transaction that lawyers should look at and be aware of? And this in part goes back to what I was discussing earlier in this presentation around what are your risk management tools. And your risk management tools are the requirements that you're putting into a contract before completion or that exchange of money is permitted to occur. And the key ones are, what are the warranties you're asking for or giving? These are the promises about the status of the business. What are the indemnities that you're being asked to give? An indemnity is effectively a contractual promise to pay someone if a certain event occurs. So it may be that as part of DD, it was identified there's a disgruntled employee. On the buy side, I might say, look, we're a little bit worried about that employee coming back and making a claim against us after the sale. We need an indemnity from you, seller, that you will pay us if that happens. So that's what an indemnity is. Again, it's a risk management tool, very big piece for lawyers. And the warranty and indemnity framework is something that's the most heavily negotiated, typically as part of a sale. The final thing is the conditions precedent, and these are the requirements that I was referring to earlier. So these are the conditions that have to pass before a transaction can effectively proceed, settle, or complete, which is all the same word for exchange of money. But as I was saying, these include things like getting a change of control consents. It may be additional warranties. It may be confirmation from the seller that no material adverse change has occurred. But again, these are a really core risk management tool, both for seller and buyer, in order to make sure that you're effectively risk mitigating going into one of these contractual arrangements. Now, when conducting DD, is there a way to complete an acquisition after a period of demonstrated performance? Yes, absolutely. So and it's distinct from the deferred consideration and earn out piece that we've been talking about. There are transactions whereby you enter into a contract, remain subject to DD, and only when and until the DD has been completed, or there may be an additional KPI attached to that, say, the company has to get 100,000 in annual recurring revenue, only then does the contract become unconditional. And at any point up until the DD and those performance KPIs being met, the document can remain conditional. So it's legally been signed. It is an effective contract. It's enforceable, but it's not at the point where it's officially complete. Now, in circumstances where you have a conditional contract, you might then ask, gee, what happens if DD really gets hairy or they don't meet the milestone? Then contracts typically have an out mechanism for the person that's requested those things. So in this case, you might say, I'm looking for the demonstrated performance of $100,000 annual recurring revenue. I have a right to walk away and to terminate the contract if that's not met within a period of 12 months from signing. So there's absolutely a way to structure transactions like this. As I said, there's 1,000 ways to skin an M&A cat, if that's the right analogy for that. But it just means that you can develop really a multitude of structures to make sure that you're adequately protected, whether buy side or sell side. And I'm about 50% split between whether I act sell side or buy side, so I do both. But it is really important to make sure that you are protecting yourself against the core issues that you've identified in DD or that make you concerned from the buy side or sell side perspective. Now, one more question. I know we're just at time. What's the best time for a business to engage a lawyer regarding M&A advice? I love this question. I'm not biased. I'm a lawyer, obviously, but I would say sooner rather than later. Definitely if you have an offer from someone in respect of a deal, most certainly if you've been presented with a contract or a term sheet or a heads of agreement. But I would also encourage the engagement of legal advice in circumstances where, as I was discussing earlier, there may not be any kind of hard offer on the table, but you're thinking that in the future you might want to exit. And what we can do is assist you with that cleanup process. So we can go through and say, look, you don't have these documents in place like the Constitution. Any buyer or investor will want to see those. We'll help you reconstitute that. So really, the earlier the better. Even if you want to, talk to me hypothetically about, I'm concerned that my valuation is too low to enter into a deal. We can also say, look, that's fine, but here's how it would work in practice. So earlier, the better. And I might end on that note around engaging lawyers early because it's time, but I know there's a bunch of questions and I'm really keen to get to all of them, but very happy to speak to people after this as well separately.
Yeah, and that is all we have time for today, everyone. Like Morgan said, apologies if we couldn't answer the question, but in the survey off the back of the webinar, if there are questions that do remain unanswered or you want to understand where LegalVision can support with an M&A query, or if you don't have any legal support and reviewing your options, anything across that, please do fill out that survey off the end of the webinar. We'll be happy to reach out and organise a time to speak with us to answer those questions. Again, we always appreciate the feedback off the back of this. Thank you for joining us. We're looking forward to seeing you on the next one.
Thanks so much, everyone. Bye.